£20,000. Every single tax year, completely tax-free. Forever. That is what a stocks and shares ISA gives every adult in the United Kingdom. And most people are not using anywhere close to the full amount. Today, I am going to walk you through what an ISA actually is, why it is the single biggest legal tax break available to UK investors, how to open one, and the mistakes that quietly cost people thousands of pounds. Here is the part that surprises most people. The dividend tax rates in the UK just went up on the 6th of April 2026. So if you are holding dividend stocks outside an ISA right now, you are paying more tax this year than you were last year. Inside an ISA, the rate is 0. It has always been 0. And that gap between the two just got wider. So let us go through this properly. Quick one before we go further. This is not investment advice. I'm documenting my own investing journey and explaining the basics. Always do your own research and check with HMRC or a qualified advisor for your personal tax situation. So, what actually is an ISA? The letters stand for Individual Savings Account, but that name is misleading. Most people hear savings and think bank account. An ISA is not a bank account. It is a tax wrapper, a wrapper around whatever investments you put inside it. And anything that happens inside that wrapper is invisible to HMRC. No tax on dividends, no tax on capital gains, no tax on interest. You do not even need to declare it on your tax return. As far as the tax authorities are concerned, money inside an ISA does not exist. Every UK adult gets a brand new £20,000 ISA allowance every single tax year. The tax year runs from the 6th of April through the 5th of April the following year. So today, if I have not used any of my allowance yet, I can put £20,000 into an ISA. Tomorrow, the same. Every contribution after that counts toward the same 20,000. And here is the critical bit. If I do not use the full allowance by the 5th of April, the unused portion is gone forever. There is no rolling over. There's no catch-up year. The allowance resets to a fresh 20,000 on the next 6th of April. And what I missed last year is just lost. There are different types of ISA, two main ones for most investors. A cash ISA, which is essentially a tax-free savings account paying interest, and a stocks and shares ISA, which is the one I use for this entire journey. The stocks and shares ISA lets you hold shares, ETFs, investment trusts, bonds, and similar assets. All the dividends those holdings pay are tax-free. All the gains when you sell are tax-free. The difference between the two is enormous over time because shares historically grow faster than cash interest pays. Quick comparison, £20,000 put into a cash ISA at 4% interest pays you £800 a year. Tax-free, yes, but it is just interest. £20,000 in a stocks and shares ISA earning a 5% dividend yield plus 4% average capital growth pays you £1,000 in dividends and grows the underlying capital at the same time. Both tax-free. Over 30 years, the cash ISA roughly doubles. The stocks and shares ISA with reinvestment roughly triples or quadruples. That is the gap. And neither sees a single pound of tax. Quick one, this channel is following an actual UK stocks and shares ISA from £200 a month all the way to whatever it becomes. If you want to see what £20,000 of compound tax-free dividend growth actually looks like over a real journey, hit subscribe. Now let us talk about the dividend tax piece because the timing of this matters more than ever. Here is what you pay if your dividends are outside an ISA in the 2026-27 tax year. The first £500 of dividends each year are tax-free. After that, basic rate taxpayers pay 10.75%. Higher rate taxpayers pay 35.75%. Additional rate taxpayers pay 41.35%. Those rates went up by 2 percentage points on the 6th of April this year. So whatever you were paying last year, you are paying more this year. Inside an ISA, the dividend tax rate is 0%. No matter how much in dividends the holdings inside the ISA pay you. No matter what tax band you're in, 0. So the gap between an investor holding the same dividend stock inside an ISA versus outside an ISA just widened. And it widens further the more dividends you receive. For someone earning £5,000 a year in dividends, holding outside an ISA now costs over £480 in tax annually. Inside an ISA, the same £5,000 is yours. And the dividend tax saving is only half of it. The other half is capital gains. When you sell shares for more than you paid, the profit is normally taxable. Outside an ISA, the capital gains tax-free allowance has been cut hard over recent years, down to £3,000 a year now. Anything above that is taxed at 10% or 24%, depending on your band. Inside an ISA, capital gains tax is zero, so the ISA does double duty. Tax-free dividends while you hold, tax-free profits when you sell. So how do you actually open one? You pick a broker that offers a stocks and shares ISA. The big UK names are Trading 212, where I hold mine; Hargreaves Lansdown, the most established; AJ Bell, well rated for cost; Vanguard UK, low-fee passive index investing; Interactive Investor, flat fee model that gets cheaper above a certain portfolio size. Each has a different fee structure, different range of investments, different interface. The one I use is Trading 212 because it has zero trading fees, fractional shares, and automatic dividend reinvestment built in. But the right broker depends on what you want to hold and how much you are investing. The actual process to open one is straightforward. You give the broker your name, address, date of birth, and national insurance number. They run an identity check. You fund the account by bank transfer. You declare that you have not opened a stocks and shares ISA elsewhere this tax year because the rule is one stocks and shares ISA per provider per tax year. The whole thing takes about 15 minutes online. From the day the money lands in the account, you can start buying. 5 quick mistakes to avoid. 1. Opening a stocks and shares ISA with 2 different providers in the same tax year. You can hold ISAs at multiple providers from previous years, but new contributions in any given tax year must go to one provider. 2. Leaving the allowance unused. £20,000 is not a small amount, and missing a year permanently loses that capacity. 3. Putting cash into a stocks and shares ISA and then leaving it as cash for years. The wrapper protects you from tax, but cash does not earn meaningful returns inside it. The point is to actually invest. 4. Selling shares inside an ISA without reinvesting. Tax-free gains are fantastic, but only if the money keeps working. 5. Confusing a stocks and shares ISA with a lifetime ISA. The lifetime ISA has a £4,000 annual cap, a 25% government bonus, and is restricted to first home or retirement. It is a different product entirely with different rules. And one important note: opening the ISA is just step 1. The wrapper protects you from tax, but it does not earn anything by itself. You still need to actually invest the money inside it. The most common things people hold in a stocks and shares ISA are individual UK shares, like the ones I cover on this channel, broad index funds tracking the FTSE 100 or the global market, dividend-focused ETFs, and a smaller allocation to bonds or cash for stability. There is no rule about what you have to hold. The right mix depends on your time horizon, risk tolerance, and whether you want income or growth. For a long-term dividend investor like me, individual UK dividend stocks plus the occasional ETF makes sense. For someone newer or with less time to manage holdings, a single global index fund is genuinely a defensible choice. A quick word on the alternative people often ask about: the self-invested personal pension, or SIPP. A SIPP is also tax-advantaged for dividends and capital gains. The difference is access. ISA money is yours to withdraw at any age without penalty. SIPP money is locked away until age 57 currently. For dividend investors specifically targeting retirement, the SIPP can actually beat the ISA on tax efficiency because of the income tax relief on contributions. But for most people building a dividend portfolio in their 20s or 30s or 40s who might want flexibility, the ISA wins on optionality. Many people use both, and for good reason. But for this channel, the ISA is the foundation. Everything I cover stays inside the wrapper. Quick note on my own setup. Every single share I have bought on this channel is held inside a trading 212 stocks and shares ISA. £200 a month, all of it sheltered. The first dividend lands in early June, and not a penny of it goes to HMRC. That is the entire reason I structured the channel this way from day one. Over a 30-year journey, the difference between investing inside an ISA versus outside one can be tens of thousands of pounds in saved tax alone. It is not a nice to have. For UK dividend investors, it is the foundation. That is the Stocks and Shares ISA in one episode. £20,000 tax-free per year, zero tax on dividends, zero tax on gains. Available to every UK adult. Use it or lose it allowance that resets every April. If you want to follow this entire journey from £200 a month to a real dividend income, all of it inside an ISA, subscribe. New episode every week. Now I want to hear from you. Are you using an ISA, cash, stocks and shares, or both? Drop it in the comments. The answers genuinely shape what I cover next. Until next time, happy investing.